Hey, good morning, everyone. Marty Missouri here. It is Wednesday, the 23rd of April, 2025. This is going to be a super quick presentation. I feel compelled to continue to comment on the markets for you. Today's schedule just allows me just a few minutes just to touch on the markets, maybe make one or two related points. In fact, let me just go there, and there's so much we can talk about, and we will, no doubt, in the coming days. One thing that just kind of jumps out at me today is related to what I said yesterday or the day before the last video, and it had to do with information or data or commentary coming out of the transportation industry. I mentioned the potential for empty shelves going forward. One kind of confirmation of that is just how industries are adjusting, at least for the moment, and how they're thinking about, the go forward relative to everything that they're hearing in terms of policy. With regard to trucking itself, we've just got some data out from ACT Research, and this is per commentary from our resource, Peter Bookvar, who, as I mentioned, is a real asset to us. The March Class 8 truck order data, which are heavy trucks. You noticed I have heavy truck sales in our index that I comment on when we get the monthly data, and how good it has actually been as an economic indicator in the past. The part of the report that sticks out at me is that cancellations have risen to the highest point in the last couple of years since mid-2023. These are orders that were placed in anticipation of a growing economy and growing trucking needs. A good chunk of those have been canceled. As for smaller trucks, class 5 to 7, orders fell 33% year over year. These truck orders have slowed through the past 4 months as current bloated inventories and a weaker economic outlook weigh on new orders. And then just various commentary from other companies. Zion Bank CEO commented on his call that he actually asked artificial intelligence, ChatGPT specifically, to speak to what's going on in the world we live in. Essentially, the reply was, Trump's tariffs have caused quite a fuss, with markets unsure who to trust. Will prices ascend? Will trade wars extend? Or will growth just stall in the dust? His comment is that actually seemed to explain the time we're in pretty well, he thought. He went on to say that while the outlook guidance always comes with disclaimers about the limitations of forward-looking statements, it's worth emphasizing that the particular difficulty right now for us and everybody else in this industry is forecasting results a year from now. So that more or less sums it up. When looking through the earnings statements, of course, we're in the heart of earnings season, and it's not all that bad, honestly. It's not like everybody's falling off a cliff or panicking, but yes, some industries are, some people are, no doubt, sounding a bit panicky. For the most part, it's just, there's just uncertainty, and it's really hard to make decisions. We're putting things on hold. As I suggested with trucking, we're canceling some orders and so on, and it's just kind of a wait and see. Now, as we've been saying here on the videos, unequivocally, there will be, at a minimum, rhetorical support for the market. More than that, I'm sure. I said yesterday or the day before that there's no doubt that we're going to hear commentary, or we're going to get announcements of great trade deals. What got the market really excited apparently yesterday, and then more news this morning. First, that the president said he's not going to fire Chairman Powell, and he really kind of backed off the attack there, the verbal attack. Market loved that. And today he said essentially that ultimately, these China tariffs are going to come down. And China said, our doors have been wide open for discussions. So the market has been sending a signal that in no way, shape, or form does it like the prospects for, massive trade war, high tariffs, and so forth. As we talked about from the get-go, weeks and weeks ago, that the market ultimately is going to inspire probably different action than what's been threatened. Now, the question is, and that's the looming question, is in a very late cycle environment, in our view, with regard to the stock market, excessively high valuations, what does it take to ultimately bring a market clearing event where we get this these excesses out, where we actually have perhaps just a mild recession and so on. Folks, these things are inevitable in the economy and in markets without regard to whether there's going to be a massive trade war or not. Folks will say, this was it, this is what caused it. Yeah, you can say this was the catalyst that ultimately would bring on the inevitable, but markets just don't go to the sky perpetually, and economies go through cycles. It's a very healthy process, and these things are due. Our concern, our long-term concern, is that the powers that be don't let market and economic forces play out, and they keep juicing these bubbles that we have. And we know now that the capacity to do that is very limited by inflation. So we don't have a setup like we did just even 2017, where you could throw juice into the economy and really get some positive oomph out of it. This is an environment where if you do that too much, the economy just may not have the capacity to absorb it without higher interest rates and higher inflation. And that becomes that becomes the makings for a bear market like we had in 2022 with a 27% decline peak to trough. It makes me think of Liz Truss, who took over for Boris Johnson in the UK and announced all these growthy policies, and her prime minister tenure lasted 16 days because markets blew up. U.S. stocks went down 10%. The UK government bond market hemorrhaged. The UK pension system almost went out of business. UK equities tanked. And what she was doing was announcing tax cuts and infrastructure and all these pro-growth policies. Well, she did it at a time when inflation was the problem, and markets blew up on her, and so did her career. People have dubbed the potential for a 2017 style, growthy policies hitting all at once as being potentially a Liz Truss moment for the U.S. I don't know that there isn't more capacity now than there was when Liz Truss took office for a brief moment to extend some growthy policies. There certainly will be if they allow the economy to contract a bit without trying to rescue everything along the way. So there's my ranting on that. You've heard that from me before. Let's take a quick look at the markets. The S&P 500. This is the chart I showed you the other day. We'll just do this quickly with the daily chart. Remember, I said that none of this should be of any surprise to anybody. Pardon my big fat line there. I'll make it smaller. So here is that 50% retracement level that we virtually hit right there. And here we were today, and you can see we came up, threatened it, and you can see there's been some selling since. And right now, the S&P is still doing really, really well. But it's not up like it was. It was up well over 3%. It's now up just under 2%. The Dow was up, I think, close to 1,000 points. It's now up 600 points. And not all stocks are up, by the way. Consumer staples, which have been great for us, are down 1% today. Energy stocks are down 0.2%. So we're definitely getting some upside in our core portfolio. But even that's waned. I think we're only up like 0.25 point right now. So we've got this stopping and this churning. And we have really what still looks like, bear market action. Remember, I said right here, look for a massive rally. And we've been getting that. And I said these bear market rallies, and I've shown you from past bear markets, they could go weeks and months. So this is good news, certainly today, that if the trade war were to dramatically abate, we could go considerably higher. We just have to wait for the data to come in. Have we indeed already moved into a situation where, recession is finally seriously on the cards? One economist who's been getting it right consistently the last few years has recently given a 75% odds of recession this year. That can change, of course. That can change with data. That can change with different policy. And maybe those odds diminish notably, and we will adjust to those odds as they develop. But right now, we still have our overall general concerns. The NASDAQ 100 index, tech is just having a wonderful day. The top of this candle right here is where it's been. You can see it's contracting a bit, but just boom, it blew through that trend line that I drew here the other day and above the 20-day moving average. So technically, that's positive for the moment. Big gap right here that could get filled if we get any disappointing news. Yields have actually come down a bit today, which is interesting because this should all be economically positive. But remember, yields have spiked out of fear that we're getting this big exodus from U.S. assets, U.S. treasuries perhaps, friction, lack of liquidity in the treasury market. I said yesterday or the day before that it's going to be fiscal policy or the executive branch news as opposed to the Fed news that's going to help the markets, and that's exactly what's happening so far today. The dollar has rebounded a bit, right? So money flowing back into the U.S. or just traders bidding the dollar up on optimism. And then let's look at our gold chart. Remember I said right in here that gold was getting stupid, and we had another big, looks like a blow-off top to me. Big decline, as you can see here in gold, big relative to what we've seen. It's down 3% as I speak, so that's a pretty good drop. Remember right here, I said this is a setup for more than just a 1 or 2% decline. In 2 days, we're down about 4%. Gold is a not small position for us, so we're certainly feeling it, but we did hedge it. The position is definitely down today. We're mitigating about 20% of the decline. But we're already pushing pretty close to our strike price here. So we can't get crippled with our gold position. We really don't have a big enough position anywhere to cripple us in a downturn in a single position. But when the technicals are compelling, we do want to protect positions that we have in size. And the technicals are telling us here that gold is due for a pretty good correction. And again, this is something we're very bullish on long term. So folks, I said it would be quick. I had to do a hard stop right here. We'll be back very soon. Hope these commentaries are helping you keep these things in perspective. And as always, thank you for watching and listening, and I'll talk to you very soon. Take care. Bye-bye.